Welcome to the Deep Dive. Today we're taking a scalpel to the Q3 2025 earnings call for Playtika Holding Corp.
And this is a fascinating one.
It really is. We're looking at a company that's, well, it's right in the middle of a massive strategic shift.
A huge one. I mean, they're deliberately letting revenue slide in what was once their cornerstone game.
All to build this higher margin direct-to-consumer future.
Right. And the big question hanging over everything is whether that new engine, that DTC growth, is strong enough to pull the weight of everything else.
The legacy business, the debt, there's a lot to pull.
A lot of weight.
So our job here is to really figure out what management was trying to tell us. You know, what was behind that huge jump in margins? How are they actually managing this big product headwind?
And maybe most importantly, why did the market seem to like it? The stock was up about 5%, even with some, frankly, confusing headline numbers.
That positive reaction is the key, I think, because if you just glanced at the headlines, you would have seen some really conflicting signals.
Oh, absolutely. A classic case of not judging a book by its cover.
So let's just jump right into that financial snapshot, because it was a classic tale of two EPS numbers.
It was.
On a GAAP diluted basis, the number that usually hits the wires first, the company posted 11 cents per share.
Which was a miss. The consensus was looking for 14 cents, so right away you see headlines about a miss.
But, and this is the important part, if you dig just one layer deeper,
the market completely ignored that GAAP number. It was all noise. They were focused entirely on the adjusted or non-GAAP EPS,
which came in stronger at 18 cents.
And crucially, that number actually beat the street's consensus of 17 cents.
So management did a good job of guiding everyone to look at the operational metrics and, well, the operations delivered.
They really did. And the top line sort of confirmed that underlying strength.
Revenue hit $674.6 million.
Which is up 8.7% year over year. A solid number.
And it was a slight beat versus what the street was looking for. But the story of the quarter wasn't really the revenue, was it?
Not at all. It was the explosion in profitability. This is where the real deep dive begins.
Okay, lay it on us. Adjusted
EBITDA. It came in at $217.5 million.
Okay.
But the fascinating part is that it surged. Get this. 30.2% sequentially, quarter over quarter, which delivered a 32.2% adjusted EBITDA margin. That kind of expansion, I mean, that just overshadowed everything else.
And that margin expansion ties directly into the first pillar of their strategy, right? This big bet on direct-to-consumer or DTC.
It's their whole story right now.
So for you, the listener, the big question is that margin level, that 32%, is that real? Is it permanent?
Before we answer that, let's just look at what's driving it. The strategy is working. They had record DTC revenue.
How much?
$209.3 million. That's now 31% of their total revenue mix.
And that's growing fast, right?
Up 20% year over year.
And management isn't hiding their ambition here. They said it pretty explicitly on the call.
They did. They want to hit a 40% DTC mix on a run rate basis.
And the timeline for that?
The next 2 years. That 40% is kind of the finish line for this phase of the plan.
To get there, you need a serious growth engine. And for them, that's the SuperPlay portfolio.
Right. The CEO, Robert Antokol, he specifically called out Disney Solitaire.
The star acquisition.
The absolute star. He said it's scaling faster than any title in the company's entire 15-year history.
That's a huge statement.
It's tracking at an annualized run rate of over $200 million.
Over $200 million for a newer title. That's phenomenal.
But it does raise a question, doesn't it? Are they pushing too fast?
It's a fair question, but they seem to be leaning into the momentum. They confirmed they've already got a new Disney and Pixar game in the pipeline.
So the fourth game from that SuperPlay studio.
Exactly. They're trying to de-risk their reliance on just one hit by just building out the partnership. Okay, that makes sense.
And on top of that, there's a potential tailwind here that could help their entire DTC push.
What's that?
It's these U.S. court-driven changes to the Google Play policies.
Ah, right.
I mean, if these policies start to favor first-party payment routing, letting Playtika collect cash directly without Google's cut.
It's a game changer for the economics of the whole model.
A massive amplifier for every single dollar they can push through that DTC channel.
So that's the growth story. It's compelling. But let's circle back to the margin question. Where did that 30% sequential jump in adjusted EBITDA actually come from?
Okay, this is where we have to get into the details a little. The jump was mostly from a a planned step down in their performance marketing spend in the second half of the year.
A planned step down.
And it was specifically tied to the SuperPlay acquisition and something called the earnout cadence.
Okay, you've got to unpack that for us. Earnout cadence, what does that actually mean, and why does it tank marketing spend?
So when Playtika bought SuperPlay, they likely agreed to pay the original sellers more money, that's the earnout, if SuperPlay hit certain growth targets in a specific time frame.
Right. Standard M&A stuff.
Exactly. So to make sure they hit those big targets, what do? You spend a ton on marketing upfront. You front load it. That was the heavy first half of the cadence.
Okay, so they juice the numbers early to hit their targets and pay out the sellers.
Pretty much. Then, once those targets are secure, or the time window is closing, they can pull back hard on that aggressive spending in Q3. That's the lighter second half effect.
So that sudden drop in expenses is what made the margin percentage soar.
Precisely. It was just smart ROI discipline tied to the deal terms. It wasn't some magical company-wide cost-cutting initiative that's permanent.
Which brings us back to the sustainability question. Does this 32% margin signal a permanent new structure?
Well, management said this heavy first half, lighter second half marketing pattern will probably repeat in 2026.
So no, it doesn't.
It confirms your skepticism. The Q3 margin is great. It shows discipline. But you can't just take that number and run it out for the whole year. They'll almost certainly ramp up spending again in early 26.
That clears up the margin picture. Okay, let's talk about the elephant in the room. The reason this whole pivot is so necessary.
Slotomania.
The unavoidable headwind.
It's really the structural anchor on the whole story right now. Once the crown jewel, now. Well, revenue was $68.5 million.
And the declines.
Sharp. Down 46.7% year over year, and down over 20% just from last quarter.
And the user numbers tell the same story. Daily paying users down, daily active users down.
They are. Though, to be fair, they did see a slight improvement in payer conversion, which suggests the users who are sticking around are the really loyal, high-value ones.
Management's word for this was self-inflicted.
And that's the critical phrase for you to understand. This wasn't some competitor coming out of nowhere. This was a deliberate, purposeful rebalancing of the game's economy.
They're changing the progression, the rewards, the pricing.
Everything, all to try and stabilize the long-term returns from their players.
That sounds like trying to fix a plane while it's in the air.
Yeah.
How hard is it to change the core economics of a decade-old game with a huge established player base?
It's incredibly difficult and super risky.
Why?
Because you risk alienating the whales. That small percentage of high-spending, long-time players who drive most of the revenue.
So they're basically choosing long-term health over short-term revenue.
Exactly. They even cut marketing for the game because why acquire new users who won't be profitable under this new, stricter economy?
Right. So their outlook is pretty sober then.
They are not assuming a quick recovery for Slotomania. They're just focused on finding a floor, finding stabilization.
And to help with that, they're launching a new slot title, Jackpot Tour.
In Q4, yes.
But hold on. If you're trying to fix a big legacy slot game, why launch a new slot game? Isn't there a risk of cannibalization?
It's a great question. Their argument is that Jackpot Tour is built to reach an adjacent audience, a different type of player that Slotomania doesn't currently attract.
So the hope is the new game adds to the total, doesn't just steal from the old one.
Right. The goal is stability for the whole casino portfolio, even while Slotomania is still in triage.
Okay. Let's talk about another piece of the efficiency story, AI. They mentioned it a few times.
They did.
And the big critique you always hear on earnings calls is that AI is just a buzzword. What are they actually doing with it?
Here, it really feels like a key lever. They're using it as both a productivity tool and a personalization engine. They pointed to initiatives in their House of Fun studio and their LiveOps stack.
Okay, so what does that mean in plain English?
Look, think about it this way. Traditionally, you have teams of people who manually set up in-game events, special offers, prices.
Right.
Playtika is using AI to automate a lot of that. The AI analyzes tons of data to personalize offers for individual players.
Which is critical for their DTC channel.
Absolutely essential, especially for maximizing what they get from their highest value users. AI is what lets them build those personalized payment flows and scale up to that 40% DTC target without their costs exploding.
So AI isn't just about cutting costs, it's about building the sales infrastructure they need.
Precisely. It lets them scale revenue without scaling operational costs at the same rate. It connects directly to that margin game we saw.
Okay, shifting gears to the investor context. Even with the Slotomania mess, management gave the market some stability.
They did. They reaffirmed their full year 2025 guidance, both for revenue and for adjusted EBITDA.
No negative surprises for the full year.
And then they dropped the big one, the capital return signal. The board declared a 10-cent per share quarterly dividend,
Payable in January 2026.
and at the current share price, that works out to about a 10% forward yield.
A 10% yield. That's what gets the market's attention.
That is a huge carrot.
But we have to talk about the risks, because the balance sheet is still the big anchor on this company's valuation.
It is. The primary risk, if you zoom out, is just the sheer amount of leverage. They have about $2.38 billion in long-term debt.
Compared to cash of, what, $640 million?
Roughly, yeah. That leverage is what's keeping a lid on their valuation multiples.
And there's one specific part of that debt that investors need to be watching like a hawk.
The senior secured revolving credit facility.
It is a March 2026,
Yeah.
what do they call it? A conditional maturity trigger. That sounds highly technical. You need to break that down for our listener.
It is technical, but it is maybe the most important part of the entire investment thesis.
Okay.
Essentially, it means that if Playtika fails to refinance a smaller piece of their debt by March 2026,
Then what?
then the entire, much larger revolving credit facility becomes due immediately. It's an acceleration clause.
So, if their finance team fails to get this one extension done, the company could suddenly face a liquidity crisis no matter how well their games are doing.
Correct. It completely changes the risk profile. It's no longer an operational risk, like fixing Slotomania.
Yeah.
It becomes a pure capital markets execution risk.
And that's why the stock is so cheap.
That's why it has underperformed the gaming ETFs so badly. It is 100% a turnaround-dependent story, and step one of the turnaround is fixing the balance sheet.
Okay.
And now we turn to our segment. This is not financial advice. This segment is for hypothetical consideration only and does not constitute a recommendation to buy, sell, or hold any security. Any investment decision should be based on your own research and consultation with a financial professional.
All right, thank you for the necessary disclaimer. So, given that huge debt overhang and that single point of failure, what's the outrageous but plausible trade idea that comes out of this quarter?
The thesis is simple. The stock is currently trading like a distressed bond that has some equity upside.
A debt instrument? What?
Because that 10% dividend yield is like a massive interest payment for holding the asset. But the principal, the stock price itself, is being held down by that one thing, the March 2026 maturity trigger.
So the trade is a pure bet on management solving that one binary event.
Exactly. The outrageous but plausible trade is to go long the equity, short term, based only on the bet that management gets that credit facility extension done before the deadline.
And if they do?
If they announce a successful extension, say in Q4 or early Q1, the stock instantly de-risks. Overnight, it goes from being a speculative turnaround to a high-yielding, safe-ish asset. The equity value could surge.
And if they don't?
If it's delayed or it fails, the whole thesis collapses. The liquidity risk becomes real, and the stock price could crater. It is a binary bet on the execution of the finance team.
That is a high-stakes bet on a piece of paper getting signed, not on how well Disney Solitaire does.
It is the single biggest non-operational catalyst in the entire story, and it provides the most leverage for a short-term trade.
Okay, let's wrap this all up. We've seen the core tension this quarter. On one side, you have this high-growth DTC momentum from SuperPlay and these impressive, if maybe temporary, margins.
And on the other side, you have the structural self-inflicted wound of Slotomania and that massive debt overhang defined by that March 2026 deadline.
And the market, at least for today, chose to believe in the growth story and that dividend yield.
It did.
So what does this all mean for you, the listener? Here's the final thought. Given that management has pulled back marketing spend until Slotomania stabilizes, is it possible that this new game, Jackpot Tour, is their only real path to stabilizing the casino portfolio in the short term? Or will Slotomania just remain an anchor they can't lift, even into 2026?
That's the strategic uncertainty they're facing.
Yes, all while trying to push towards that 40% DTC mix and continue their AI-driven transformation. Thank you for joining us for this deep dive.